I'll talk about the same thing that Enrico mentioned from a slightly different angle. In the Savings and Investment Union, I think the major obstacle is not so much savings, but investment. And the single market is a conduit for actually generating higher investment in the Eurozone. We all know that Europe, especially after the great financial crisis, lags behind the US, both in productivity and in GDP growth. And everybody understands there's a consensus that we need to invest more to become more productive and generate higher growth, and especially invest in the digital economy, in high technology. Financing is an issue. We want to have plenty of financing, but it's less of a constraint and less of a problem. And because we know that Europe saves a lot, and as Enrico just mentioned, it saves a lot, but the money leaves the Europe, goes to the US. It's financing the current account deficits of other countries. So it's not financing more investment. And that's exactly what we need to do. Raise investment, use the extra savings we already save, and plow it into domestic investment. And the European Investment and Savings Union aims exactly to rectify this disequilibrium, namely how to channel European savings into investment projects, European investment projects. And a well-functioning single market would do that, okay? Would raise more investment opportunities, would make companies grow bigger in size, have bigger projects. And we know from experience in the last 40 years that in the past, whenever Europe took big political projects, unification projects, investment actually went up. And I'll show you some graphs to justify this thing. And I'll start with investment. You see on the left is that there's a comparison with the EU, the US, and the UK for 2 decades, and how much they spend on investment in communication technology and research and development. And the US is spending 6% of its GDP, but Europe only 4%. And on the right, you see the productivity. The red line is the US productivity. After the great financial crisis, keep going up at a higher rate than in Europe. So I connect the two. We need to invest to be able to be more productive and grow faster. And that's really the aim. And when it comes to savings, on the left-hand side, there's a graph of the savings rate. That's the blue line. And on the orange line is the investment rate. You see that after the great financial crisis, there is a gap between the blue line, the savings, and the orange line, investment. We save a lot, but we don't turn it into more investment. Okay? So there is money out there, but it's just not being utilized. And in fact, and it's not the cost of investing. On the right-hand side, I have 2 graphs for different corporations, a comparison of the US with the European companies, and you see that the cost of funding is similar, whether you're a large company or a small company, you're a AA company or CCC company. So funding is not the primary issue, investment is the issue. And here is a graph that shows the barriers across our borders act as tariffs. And this is services in the year 2020. On retail, you have the smallest tax rates, about 60%. On accommodation, you have 320%. This is incredible. I mean, we worry about Trump and his tariffs, and we have higher tariffs in Europe. And it's the same thing for goods, a bit less, but that's the same story. And this actually gets reflected in the financial sector. Companies are segregated. There's fragmentation in the real markets. There is fragmentation in the financial market. And this graph shows whether banks have outside their border claims. After the Eurozone, somehow there was more unification, but after the great financial crisis, we're going back to our border. We're not outside. And as a result, I mean, the whole capital markets union started from the fact that we have a very small capital market in Europe. The Americans are dominating. We want a bigger capital market. And we say we are a bank-based economy. But when you look at our banks, we have small banks. On the right-hand side, I have that as of 2 days ago, July 1st, last Tuesday, the capitalization of the 10 largest financial groups in the world. There is only one European. It's not even now European, it's British. Now, it's not in the EU 27.
We like to think we're European.
Yeah, okay. We call you European. So there are we don't have even large banks. And on the left-hand side, you see that these large financial groups are 1/5 the size of the technology companies. And there's no European technology company in the top 10, which again shows that we need to invest. And where do we need to invest? We need to invest in the technology sector. A question mark, can we do it? Can the effort now, which is spearheaded with Enrico Letta and Mario Draghi and the Europeans, with the Saving and Investment Union, can it do it? There is optimism, because if you look back in the previous 40 years, you realize that here, the graph here is the investment in the euro area, in the EU 27. When the single market happened in the 1980s, investment went up. When the euro was introduced, investment went up. When EU enlargement took place in the early 2000s, investment went up. And when the Europeans decided that, gee, we should issue a common bond and invest, we have the RRF, again investment went up. So perhaps, this is the optimistic part, perhaps we can do it. Especially now that across the Atlantic, President Trump is working against what makes America great again. Against R&D, against universities, against immigration, against the dollar itself, which gave it a great comparative advantage. We have a chance to become great again as Europe.